Hello traders, how often do you have situations where you see a long-term, strong, sustained trend on a chart and once you decide to exploit it? But in this case, we have a strong bearish trend. As soon as you decide to take advantage of it and enter a trade down, right at that moment, the reversal starts and the chart starts to rise. These situations are actually quite common because while you are actually clearly defining the trend, its strength and its momentum may already be fading and the chart may be moving to a trend reversal in the other direction. And in this video, I will show you tools that will help you to clearly find the moments in which trend reversals will occur, to confirm that it is a trend reversal and not a correction. And I'll tell you how to use these moments to get into new, medium-term trends as quickly as possible and capitalize on their potential. So, the first thing we need to do in order to find trend reversals is to actually find the trend itself. In this case, we visually see a bearish trend, but we can confirm it with any other indicators. For example, if we put moving averages, they will show a downtrend. Or you can determine a downtrend by the lows and highs if the highs are going down every time. Here's the high. Now the high is lower. Now the local high is lower. Another local high is lower. And so on. This is also a downtrend. Or a local low, then a local low even lower. A local low even lower. A local low even lower. And that tells us that we have a progressive trend, that the highs and lows are being rewritten to the downside every time, meaning that the trend continues. So let's say that we have somehow determined that we have a trend here. As we know from theory, I have already recorded a video about trend channels and trend lines. In any trend, we can draw trend lines along the highs and lows on the chart. Let's say we can draw a trend line on this chart by 2 points, even by 3 points. In order to detect a reversal, we first draw a trend line. Here we have drawn the upper trend line at the highs. Here we can draw another trend line as a minimum, but we need the one that will show us the breakout. If this chart is descending, we need a top line that will be broken in case of a reversal. And if we had an ascending chart, we would need, as in this case, for example, a bottom line. We could build a lower trend channel for this upward trend and use it to look for a breakout. So we have a downtrend, clearly confirmed. We have a trend line on it. And here's the chart. Let's say we're at this point. The chart has come up to the trend line. Theoretically, if we use trend line theory, the most likely rebound is here. That is, if we had a downward bounce from the trend line before, we had a downward bounce from the trend line again. And for the third time, we are waiting for the same scenario, that when the chart approaches this point, it may bounce. But we see the trend breaking the trend line and locking higher. At this point, we can't talk about a trend reversal yet, because as I said in the video about trend lines, a trend line is not a line, but rather a zone. That is, the chart may not reach the trend line or slightly cross it, but it still remains valid. Still, even in this moment, on this candle, it is quite possible to reverse to the other side and continue the trend. Therefore, in order to confirm a trend reversal, we need some kind of signal to confirm the trend. It can be either a candlestick pattern, as in this case, we see 3 consecutive green candles. This is also a candlestick pattern, which indicates that there is a strong momentum upwards. Either we can confirm the trend through the lows and highs, as I explained before. Here we have a local high. The next local high is higher. The next local high is even higher. This indicates that the chart is no longer going down, and the fact that the market's efforts are now directed in the other direction, in the opposite direction. The same can be said for the lows. We have a local low, a second local low, above a third local low, a fourth local low, even higher. This means that the chart rewrites the lows and highs to the upside every time. And here we can already confirm the trend reversal. And at this point, we can already consider it as a trend reversal breakout and already use the new trend to make trades upwards. Let's look at the same thing on another graph. Here, let's say we have a clear downward trend. Again, we can draw a trend line from the local highs. Here she looks like this. We apply the same trend theory. When the chart approaches the trend line, We wait for a bounce down again, bounce down again, bounce down again. In this case, when the chart approaches the trend line, we should again wait for the trend to continue and bounce down, but that's not happening. We again see strong patterns that suggest a trend reversal, an uptrend. We have 4 consecutive green candles with a fairly long body, relatively long body, which suggests the start of a new trend. Again, we can check the same thing from local highs and lows. A local high at this level, then a local high higher, then a local high even higher. And we can check the same thing from local lows. Here we have a local low, here we have a local low higher, here we have a local low even higher. Thus we can confirm through several different signs that this is already an uptrend. And here we can already make upward trades that forecast growth. And this trend can be considered complete, a downward trend. In these 2 cases, we have looked at scenarios where the chart reverses in the other direction after trending. But in fact, after the trend line breakout, I once again showed the structure of the trend line and its breakout. After the chart breaks the trend line, it cannot necessarily go into the opposite trend, but also go flat into a horizontal movement without much volume. As in this case, if we do not see a clear confirmation of a new trend. Let's go over how we confirm the breakout of the trend again. The end of the trend. We have a trend at local lows. We can build a trend line. Here's what it looks like for a rising chart. Once the chart has broken the trend line, the local trend is over. And we can now confirm the start of a new trend. But there are no figures or signals here that confirm a reversal in the start of a new trend. We don't have any updated local lows, we don't have any candlestick patterns, and so on. The graph just went horizontal, and no new trend has emerged. In this case, in order to find new entry points, we need to use horizontal resistance levels, local resistance, or support zones. If the chart was downward before, we can build a horizontal line, and as soon as the chart touches it here, or further, we can use this point to start a new trend, to start a reversal pattern. Conventionally, this line does not exist yet. We have a chart breakdown. We can see that a new trend is not forming. So we're using the previous local highs to set key levels. We have the key level right here, and we are waiting as soon as the chart reaches it. As soon as the chart reaches it, we will open a trade down. Let's give this key level. It is often the case that the chart does not reach the same key levels as it did before. In this case, we can use indicators that indicate a reversal to find new entry points. For example, Stochastic. Stochastic shows overbought and oversold levels. Once both lines are above the blue zone, it means overbought zone. So the asset is worth more than the average for the last period. This is called overbought. In such a zone, we are waiting for trades down. We're waiting for the drop down. If the stochastic indicator is below the blue zone, it is called oversold. This means that average prices are lower than the prior average. Now, after the trend is broken, we can use not necessarily key levels, but we can use stochastics to find new entry points. Here's where the stochastic has almost passed into the overbought zone in this signal. And if we didn't use the key level, if we used only stochastics, we would miss this signal because stochastics doesn't confirm it. But we get into the deal right here. At this point, the stochastic is showing overbought. And according to our theory, if the trend is over, the chart has gone flat. At this point, we can use the entry point to continue the trend down. Stochastic shows overbought, and at this point we enter the trade down and get a good profit on it. This is how you can recognize reversals of previous trends. In both cases, we need to wait for the chart to cross and consolidate behind the trend line, behind the previous trend line. And what to do next depends on whether a reversal trend started immediately or the chart went flat. If immediately, after the breakdown of the trend line, a new trend has not started. After we have confirmed that the trend we can enter trades upwards, if after the breakdown of the trend line, a new trend has not started and the chart has gone flat, we can use either key support, in resistance levels or stochastics to find new entry points in the opposite direction. That's such a simple strategy. If you practice using it on live charts, you will find chart reversal points quite quickly and will successfully apply these moments for entry. Share in the comments your success in applying this strategy. See you in the next videos. Bye.